Welcome along, everybody, to today's webinar, SMSFs Acquiring Assets from Related Parties. As I indicated in sort of, I guess, my advertising and paraphernalia around this webinar, this is a subject matter that I particularly get a lot of questions on and have got a lot of questions on over my journey in self-managed super funds, which of course sort of is well and truly over 20 years. And these rules, effectively, the acquisition of assets from related party rules, coincides ultimately with when I started in the SMSF industry. So I've got to sort of grow with it, and it's certainly been the area that I've had probably the most to deal with from an SMSF compliance point of view. And in saying that, I'll also say that it's still to this day probably the most complex area that I deal with reference to what people are going through with regards to acquiring assets from their fund. Interestingly enough, when we talk about self-managed super funds acquiring assets from related parties and being a contravention, it's interesting to note that of the 40-odd thousand contraventions that the ATO get reported or had reported last year, only 1% represent acquisitions from assets from related parties. So they don't make up a huge issue from an actual compliance point of view. Now, to me, that suggests one of a couple of things. One, that people understand the rules, or two, that some assets are being acquired that shouldn't be, or three, that people are at least seeking out advice, whether it be from the fund auditor, from the administrator, or from other parties when getting or dealing in this sort of situation. So all of these sorts of things lead me to suggest that it's one of those areas that's still questioned in many respects, but we do in many instances get good resolution from it. So what I want to talk about largely today is really that the issue about the acquisition rules and other SIS regulatory requirements, and that's pretty critical to me. There's a whole heap of areas that potentially, when we look at SMSF contraventions and the issues raised by the ATO, maybe the acquisition of assets from related parties is the least of worries in a lot of scenarios, and there may be more issues around sole purpose test, which represents about 10% of all breaches. Obviously, financial assistance and loans to members, which makes up about 20% of all breaches. So when we're referencing a lot of these investment restrictions, particularly that can be around related party transactions, they do make up at least probably, by my estimation, about a third of all contraventions that occur in the SMSF space. And I think you can actually, I did the maths one year, I think you could actually suggest that when you add separation of assets and other areas, that probably 3/4 of all SMSF breaches are related party transactions. So getting it right from an acquisition point of view is a key area. So I will touch on how the SMSF advice program operates. I'll work through that at the end of the presentation, and with that, what the ramifications are for when people get it wrong. So what are the requirements is what we will work through. And then, and what are the key questions? So again, when I was promoting the webinar, the key thing to me was that there are ultimately 3 questions that should be asked when acquiring assets. And the answer to the first question is inevitably going to determine whether you need to answer the second question. Then the answer to the second question is going to determine whether you need to ask the third question. But I think it's important that we always start off by asking the first question in the transaction. Now, what history has shown me is that often people sort of look at it from a compliance point of view or from an administrative point of view. They look at it backwards. So they're looking at the value of the transaction to determine whether or not it fits within a 5% limit or something like that, before then determining whether or not the transaction could have occurred in the first place. But that 5% limit, as we'll discuss, is really only relevant when it comes to the in-house assets and specific in-house assets. So it's one of those areas where if you ask these questions in a structured and orderly way, then you should be able to work through the issues as they arise for your clients when dealing in the acquisition of an asset space. So let's firstly look at the rules and how they operate with regards to Section 66 of the SIS Act, and specifically subsection 66(1), which prohibits the trustees or the investment manager of a self-managed super fund or a superannuation fund from intentionally acquiring an asset from a related party. Now, the key word there, or the key two words, is obviously the trustee bit. So investment managers are ultimately going to be making a lot of decisions on behalf of funds, less so likely in regards to a self-managed superannuation fund, unless they have provided discretionary investment powers to that investment manager. But largely from an SMSF point of view, we're going to be talking about trustees. And then the other key one is the word intentionally acquiring an asset from a related party. Now, I've highlighted ruling SMSFR 2010-1, which is the rules around a commissioner's interpretation of the acquisition of assets from related party rules. Again, it's a good ruling to give you sort of a heads up on to some of the key issues that the commissioner is looking at. But there are other areas that you then have to defer to other SMSF rulings that were released between that 2008 and 2010 period. But one of the key messages that they introduce in that ruling is that because of the closely held nature of a self-managed superannuation fund, that arguably any investment decision, the parties attached to that investment decision are well and truly known to each other. So it almost takes the intentionally part out of the equation, because for an SMSF trustee to not know the other party that they were dealing with in a situation would generally seem at odds when we're contemplating the assets that are then subject to exceptions to the rules. So, when the SMSF trustees line up to acquire an asset, they know that they're either going to their broker or going to their online broker and saying, I want to buy these shares, and they're buying them on the market, right? Well, we know that that's not an intentionally acquired from a related party. Whereas if they say, well, I want to transfer these shares from myself to my self-managed superannuation fund, or from my company, or from my family trust, then in that instance, we know that they're dealing with a related party transaction, and we know that the transaction is intentional. And so then what we need to understand is whether or not it's a prohibition to acquire that specific asset, or whether an exception applies. So the key is appreciating, sort of in my sense, that we're dealing largely in the SMSF space with the trustees, and their intention is effectively a moot point, because the SMSF trustees should have an understanding of who they're dealing with inside that transaction. The other key message that comes out of particularly from the ruling, is that the acquisition concept, and the concept of acquisition takes its ordinary meaning, but it also includes the in specie contribution. Now, one of the things that I guess has raised a little bit of in more than one way, obviously, controversy over recent times is the introduction of the non-arm's length expense requirements with funds, and largely targeting, again, self-managed superannuation funds. And whilst I don't want to segue too much into the NALE provisions, one of the key sort of flow-on effects from those introduction of those rules is that the Commissioner is taking effectively a revised look at a whole concept of in specie contributions, in the sense that because we have to acquire assets at market value, is that if we don't pay market value for something, then whilst the Commissioner effectively brings in that market value substitution rule, so we are dealing at market value, if we haven't paid enough, even if we are treating the balance as a contribution, then it could expose the fund to non-arm's length expense issues by not paying upfront the full amount. So what's then important is the actual transaction to start with, where effectively, without making a declaration, you're making a declaration to state that I'm going to transfer these shares in, partly by acquisition, partly by contribution, so that you can clearly identify that the portion that is being purchased with cash from the fund is being purchased at market, and the contribution is also then treated at market as well. So to me, it's semantics. To me, it's business as usual. But there's a bit of a fear element that can be driven by the way that SMSF, or the rule in the LCR on non-arm's length expenses was actually written. So something to be mindful of there. But yeah, so the acquiring assets from related party is prohibited. But of course, as with most prohibitions within the SIS Act, we then have our exceptions. So our exceptions being listed securities, So shares, units, bonds listed on an approved stock exchange, business real property. And of course, the whole definition of business real property is in itself lends itself to its own topic, but land or business used wholly and exclusively for business purposes. And that's one of the key areas, because one of the questions we often get is, can we transfer this particular property into the self-managed super fund? And obviously we have to go through that whole business real property definition to determine if the activities on the property warrant business activities and warrant it to the exclusion of all other activities, with the exception of primary production. And so, again, it means that these questions generally aren't answerable, within a 30-second time frame. It often requires a little bit of digging to find out full details associated with the transaction to determine if it is appropriate or not. So that's the business real property one. The next part of the exception is our in-house asset exception. So the capacity to acquire certain in-house assets, but that is subject to a 5% limitation. Now, when we talk about the three primary questions, that's where this question of valuation becomes important to me, is that as the third rung of the questions that is asked is, okay, where does the transaction sit? Is it listed securities? Is it business real property? If so, neither of those are subject to any valuation issue other than the market valuation requirement. But if it's an in-house asset, then it's restricted to 5% of the asset value of the fund. And so that's where we need to be mindful that if we breach that at acquisition, then we've failed not only the acquisition of asset rules, but also the in-house asset rules and some other things that we need to be mindful of. Then there are, and this is where a lot of people tend to get the confusion. One, the definition of an in-house asset confuses a lot of trustees particularly. But then the fact that there are certain exceptions to the in-house asset rules. So the in-house asset rules list what an in-house asset is, and then it lists certain exceptions to the in-house assets. And the acquisition of assets from related party rules sort of expands the acquisition capacity to incorporate some of those excluded in-house assets. And so when an asset is subsequently excluded from the definition of an in-house asset, but included in this overall Section 66 exclusion, then the 5% test doesn't or isn't required. So again, you've got to understand what an in-house asset is, what an exception to the in-house asset rules are, to determine whether or not the 5% requirement needs to be met at that point of acquisition. So, there is a lot to digest in that space. The other point that I raise there is relationship breakdown. So if you've got self-managed superannuation funds and you've got one fund or one member leaving that fund due to the separation and transferring to another fund, then that other fund can acquire assets from the first fund under an exception with the Section 66 rules. So there is that capacity to transfer those assets across, obviously subject to the separation occurring. So one of the key issues is that Section 66, as I've just basically pointed out to you there, is relatively, I wouldn't say it's simplistic, but it's relatively sort of well documented what that actually provides for. So here is your prohibition, here are your exceptions to the rule, and ultimately here's your penalty if you do the wrong thing. But when we actually look at the entirety of the acquisition of an asset from a related party rule, we're actually bringing into consideration a whole heap of other thought process and regulatory requirements that we need to contemplate when making that decision. So if we consider the acquisition point as central to the transaction, then the first thing that we need to look at is the trustee covenants. So, what do the trustee covenants provide for us that we need to think about with acquiring assets? Well, obviously the investment strategy of the fund. Whatever we're acquiring, is it accounted for? Have we contemplated that in the fund's investment strategy? Separation of assets. Now, this is again one of those areas that quite a significant number of contraventions that are reported are subject to separation of assets. So it might mean that the fund has contemplated buying a specific asset as such, but have they actually changed the title? So does everything reflect how it should be reflected in the super fund records. So you've got your separation of assets, your best interest requirements, and your investment strategy, just to name a few things linked to the trustee covenants. The sole purpose test. So my paraphrase for talking about the sole purpose test in regards to acquiring asset from a related party is, just because you can acquire an asset doesn't mean you should acquire the asset. And ultimately that's going to come back to the point of, is this asset providing retirement benefits for the member? Is that the purpose of undertaking this transaction versus, is this transaction to provide financial assistance to a member or relative, or is it to provide some other benefit? And look, I can't remember the name of the case from last year, but there was a self-managed superannuation fund that acquired listed securities, and those listed securities were Billabong, and the parties were the founder or one of the major shareholders of Billabong. It was transferring the shares from the family trust to the self-managed super fund. So the self-managed super fund acquired those shares. Now, subsection 66(1) provides an exclusion, or subsection 662 provides an exclusion for the transfer of listed securities. So acquiring Billabong from the family trust satisfied section 66. However, the ATO determined, and I'm not quite sure where the status of this fund or this case is actually at, but the ATO determined that the transfer of those shares, whilst in satisfaction of section 66, was more a breach of the sole purpose test, because the transfer of the shares wasn't so much to provide retirement benefits for the members of the fund, but to offset tax liabilities associated with the family trust and distributions by generating a loss inside the trust. So, the ATO will apply these look-through provisions under certain transactions to determine the legitimacy of why that transaction is being undertaken. And I think that's one of the areas that we always have to raise with trustees, is just because you can doesn't mean you should, because ultimately at the end of the day, it's got to be that the whole transaction itself is there to provide for that retirement benefit for the members, or obviously the death benefit if they pass away prior to retiring. So sole purpose test has a big part to play, which then of course lends into the lending and financial assistance side of the legislation. And for me, where this area falls down in the SMSF space, or not falls down, but sort of gets underrepresented, is that we often talk largely about loans and how self-managed super funds can't lend money to members or relatives. And yes, that represents 20% of all breaches. But the second part of that section 65 is the whole piece around provision of financial assistance. And again, there's a ruling, I think it's 2008/1, that provides a whole heap of dot points as to what would be a consideration of financial assistance, gifting, undervalue, overvalue, all sorts of different things that you could provide. And one thing that would provide financial assistance to a member or relative is buying assets from that member or relative. So if the purpose is, I need to get some cash flow on the outside, so I'm going to use the capital from my super fund to acquire the asset, well, if that's the story, then that to me suggests that you've got a financial assistance issue, you've potentially got a sole purpose test issue, but what you don't have is an acquisition of assets issue. And all of these rulings, as I said, that were written between 2008 and 2010, fundamentally each of them have very fine print that says, just because something's okay under this section doesn't mean it's okay under all other sections, but we're only addressing a singular point in this ruling. So, I've always been of the opinion that you need to make sure that you're discussing all these key issues with your clients as they go along. The Part 8 associates really fits in nicely with the in-house asset rules. So Part 8 associates really defines for us who our related parties are. So, whether we're dealing with a Part 8 associate of the members, if we've got a corporate trustee, whether we're dealing with the Part 8 associates of that corporate trustee. Now, largely, they're going to be the same. But in those rare instances where the company of a self-managed super fund is also a company of other entities, or a company that undertakes other activities, then clearly that's going to have this potential to broaden the impact of who a Part 8 associate is. So that's why the whole special purpose company is clearly a much better setup from a trustee point of view. But all critical to understand who our related parties are to work through the process. And the in-house asset requirement. So does the investment satisfy the definition of an in-house asset? And I'm going to touch on what I call the catch-22 moment of in-house assets a little bit later into the presentation. But to me, it's one of those key issues. One of the exceptions, and one of the key exceptions that I've identified as 1322C investments there. But of course, if we're talking about pre-2000 assets, and we can talk about Regulation 1322B as well, but largely any new investment in an ungeared company or trust that meets certain conditions, I'll also touch on those later, can actually be acquired. So we need to understand the benefit that these trusts bring from an acquisition point of view, but the issues associated with it if we don't get it right all along with the operation of that trust, as opposed to the operation of the super fund, and therefore create further in-house asset issues later on down the track. But certainly at that acquisition point, these 1322C investments now provide for some really obvious benefits with the transfer of property potentially over time as such. I highlight collectibles as an investment hurdle because when these rulings were written back in 2010, when they came out in draft form, the laws were going through some transitional period, and we're also going through the Cooper review back then, and there was a recommendation made as a fallout from the Cooper review to ban collectible and personal use style assets inside super fund, but also to ban in-house assets, so any investments in related parties. So the final recommendation was not taken up fully, and what they obviously did was they incorporated a set of transitional rules that are now our finality rules around collectibles and personal use assets about how we can hold these investments in super funds. But pre-2009, because of the definition of in-house assets, there was this assumption from the industry more than the regulator that any asset that was subject to a lease to a related party could be acquired from a related party. That was based on the final ruling, 2010-1, was said, well, that wasn't the policy intention because it could mean that people could transfer an asset in, lease it to a related party, then cancel that lease, and then transfer more assets in, and ultimately transfer the entirety of their wealth from outside of super to inside, which was largely the objective of this area of this section, was to ensure that funds didn't do that. So we've obviously got contribution caps and other things that take care of a lot of that now, but the collectible and personal use asset rules are still critical to this whole related party acquisition area, because often when people are contemplating in-house assets or when they're contemplating assets that by design they'd like to have in super, they'll often say, well, look, we've got a collection of artwork or whatever it might be. Can we bring that into the superannuation fund? And the very short answer to that is no. And then, to me, overriding a whole heap of all this is the contribution caps. So, what access do we have to the caps to be able to contribute these investments as opposed to acquire these investments in the superannuation fund? So having an appreciation for not just the caps, but also the valuation and the transactional side of things. So when we're dealing in specie transfers, and I know that this is an area that I've been banging on about for years, but if we're dealing with in specie transfers, to ensure that the date of purchase on those transfer forms correlates with the date of execution, so that we know what the true valuation of that contribution is, because the ATO's position is very much that the date of execution is the date of transfer, and so it's kind of irrelevant what you put up in the consideration and purchase date fields of the off-market transfer form. It's ultimately when you execute that form. So often a little bit of auditing licensing is taken on there with regards to if it's a day or so difference, and then generally that's not a significant point. But if the valuations differ significantly, then auditors, I think, are quite within their rights to question that off-market transfer process to ensure that the right valuations are being used. So these are all, to me, the investment hurdles, and it's quite possible that there's other areas that I haven't contemplated there, such as LRBAs and holding trusts and things, but they sort of come out in the wash of the other end rather than at the acquisition side of the actual transaction. So they're the key issues. Onto the key questions that I think should always be asked. Well, firstly, who or what are the parties to the investment acquisition? So we need to have that understanding of who who a related party is, and then who the parties to the transaction are. Because if we undertake this question first and we ask who the parties are, if we're dealing with unrelated parties, then really the ultimate question comes down to, is this a good or bad investment for the fund? Should I or should I not be making it, right? Not so much about, can I make it? And this whole acquisition rules is about, can I do something, and not should I do something. So firstly, identifying who the parties to the transactions are is going to determine whether or not we need to then move on to the next part of the question. So we'll touch on the related party definition and some of the quirky natures of that transaction or that part of it in a moment. Then what is the investment? Is it subject to an exemption or an exception? So this is where we sort of go, okay, well, who are we dealing with? We're dealing with a related party. So we've found that out. We've worked out that somebody is a related party. And in most cases, that's a relatively obvious determination who the parties are. But sometimes when we're dealing with companies and other like entities, it's going to be a little bit more tricky to determine that. But once we've determined who the related party is, then we need to know what the investment is, right? So we can go through the process, and we've been through that list. I'll bring the list up again in a moment. Listed securities, business real property, in-house asset, and certain exceptions. So does the investment fit into one of those categories? And if the answer to that is no, then we can't acquire it from a related party. Now, one of the other areas that we don't focus a lot on is the schemes to the acquisition of asset from a related party rules. And I still get asked the question, and often it's interesting that people will contemplate this sort of question. They'll say, if I can't acquire that particular asset from myself, what if I sell it to another party, then acquire it from them? So automatically, they have entered into a scheme or have contemplated entering into a scheme to get around the acquisition of assets from a related party rules. Now, what's quite surprising is that there's largely not a lot of case law around this sort of transaction to be able to highlight. There's an old one going back to about 2000, Locke versus the Commissioner of Tax, and then there was another one that I recall. But just from personal experiences, I've seen it where we actually had two self-managed super fund clients, and they looked to acquire shares in this private company, and when they looked to acquire those shares, they realized that it wasn't subject to an exemption. So they said, well, why don't I buy yours and you buy mine? The thing is, they both have the same auditor. And so the fact that they put all of that in writing, the auditor sort of said, well, you've entered into a scheme to get around the acquisition of assets from a related party rules. And so from a breaching point of view, they ultimately had to unwind that transaction. So I've just had a question come up. Can a self-managed super fund acquire units from a related party of a non-controlled trust, which has only a business real property asset that would otherwise satisfy the provisions of 1322C? So look, that's a really interesting question, Sunil. I'm going to talk about 1322C a little bit later, but I have had the question raised before, and for me, 1322C doesn't necessarily determine, and I might put a caveat on here that I might need to go away and do some research on this one. But 1322C itself doesn't dictate that the trust is related. It just dictates that the trust is non-geared and only invests in property and undertakes everything on commercial basis and all those other elements. So for me, the non-controlled element is not necessarily critical to the 1322C requirements. It's just that the acquisition has been from a related party and all the conditions of 1322C are actually met. So my short answer to that is that they could acquire it, but I want to take that question on notice, and perhaps what I will do for everybody when we send the CPD out is I will give a bit more of an answer to that question, either to support what I've just said or to take back everything that I've just said, subject to further research. But my short answer to that one has always been yes, that was possible in the few occasions that it's come up, subject to it meeting all the 1322C conditions. So understanding what the investment is and whether it's subject to an exception, and then from there, what is the value of the investment is it subject to subject to the in-house asset rule? So the reason I raise this as the third issue is I've seen transactions occur where the asset itself was a non-standard investment. It was worth less than 5% of the value of the assets of the fund. And so the question being posed by the trustees was, well, it's worth less than 5%, so we can transfer in-house asset exceptions. So, well, you can only do that if the asset itself met the definition of an in-house asset. And of course, that in that instance there, the investment was actually a racehorse or a horse of some description, and it was the asset was subject to a lease to a related party. So related parties were ultimately leasing that horse for whatever purposes you lease horses. And of course, that was a separate piece of the in-house asset rules that's effectively been carved out of the requirements or the capacity to acquire. So it's not just about the valuation, it's about whether it's one of the acceptable investments to start with, and an asset subject to a lease is not an acceptable investment. And so in that instance, they couldn't undertake the transaction. So these are the questions that we need to pose and ask ourselves. And as I said, in that order, when we're dealing with these transactions. So the first one is, who or what are the parties to the investment acquisition? From a related party point of view, a related party can be fund members, trustees, or the directors. So obviously, in a 6-member super fund, you're broadening the number of members. So therefore, you're broadening the number of parties that are linked. So it's one of those areas that you need to be mindful of. The bigger the fund, the bigger your related party network is going to be. A standard employer sponsor of the fund. Look, I've highlighted that one there in red because largely it's not that it's irrelevant to self-managed super funds. It's just that most employer sponsors, which is those employers contributing to the fund on behalf of their employees, are not standard employers. So standard employers are those that have an agreement in place with the trustee of the fund. So you had a lot of, in the very early days of self-managed super funds, ultimately when they transitioned from being excluded funds to self-managed funds, a lot of those funds were employer-sponsored funds. So they were set up with the principal employer, between the employer and the trustee, to make contributions on behalf of the employees. That it's largely a moot point now because most of us deal with employer sponsors, not standard employer sponsors. But then we have the associates of a member or a standard employer sponsor, and they're our Part 8 associates. So our Part 8 associates, by extension of that previous slide, are our members. It's the members' relatives, because assuming obviously that the members are also trustees or directors of the corporate trustee. It's relatives of the members, and we'll touch on relatives in a moment. It's partnerships that the members are involved with and partners in that partnership, and then the spouse and children of partners in that partnership. And then you extend that for every member of the superannuation fund. And then the final one is an entity that is controlled by that whole list of Part 8 associates. So all of the individuals make up your Part 8 associates. And if those Part 8 associates as a group control a company or control a trust, so control an entity, then we start to get into realms of acquiring assets from particular companies, generally small businesses, will often be acquisition from a related party. Now, when we start to talk about control, we've got some fairly simplistic issues associated with control, such as majority voting interest, which is more than 50% access to, from a trust point of view, we'll talk about in a moment, capital and the income. From a company point of view, it's a majority voting interest. So you do have the capacity to control the votes. Now, this has always been a contentious issue, because arguably if you have 50% shareholding, you don't have that casting vote unless the Constitution says that you do. So again, it's pretty important to see from a positional point of view, from a shareholding, from a directorship point of view, whether or not there's any casting vote issues associated with it there. But also you can ultimately potentially stop parties from making decisions because you hold that 50%. And that's where it comes under then this further condition, which is sufficient influence. And so if you sufficiently influence a company, so the company or the majority of its directors are accustomed, or as I say, under an obligation to act in accordance with the directions that you and your collective group provide, then you can influence that company as such. So, you know, it's actually going to be a matter of fact as to whether or not you have sufficient influence on that company. Your position alone won't determine it. So if you are one of multiple directors on a board of directors, and you effectively have equal say with everybody else but nothing further, then the likelihood of you influencing that company are effectively null and void. But, you know, it comes then down to your voting rights. So all of those sorts of things are pretty important. And again, beyond the scope of really drilling down for today's session, but really key in determining whether or not a company is a related company. And that's when we get into the definition of the in-house asset. So when we're looking at acquiring shares in a related company, we really want to know whether or not that company is related or not, to determine whether we can acquire certain shares. So that's where the context of majority voting interest and sufficient influence become far more relevant than the actual acquisition point of who we're acquiring from, because normally we're acquiring in largely every set of circumstances, we're normally acquiring from our family trust or from the members directly. I mean, that's been my experience. I accept that there are other occasions and other transactions, but largely it's member to fund transactions that we're dealing with. But it's then what is the entity that we're acquiring that often requires further scrutiny. A related trust is a trust that the members and their Part 8 associates control via fixed entitlement to more than 50% of the capital or income. They hold sufficient influence, and the trust where the group has the ability to remove or appoint the trustee or a majority of the trustees. So, you know, again, if you hold 50% of the units in the trust, then what does the deed say about the capacity from an appointment and removal point of view? If you've got an appointer and that appointer is not a related party, then, you know, there's a greater likelihood that it's not a related trust. But again, it's going to be critical to review all these additional documents when undertaking the transactions to find out if an entity is in fact related. And then we've got our relatives, and ultimately from a relative point of view, it's a fairly broad definition. The only people that aren't incorporated into the relatives definition, as opposed to relatives for the definition of a self-managed super fund point of view, are former spouses and cousins. So it's one of those things that we do need to have a reasonable appreciation for the extent of our family when contemplating the acquisition point, albeit, as I said, that most of the time you're acquiring shares, or clients are acquiring shares from themselves or their immediate family. So it's a relatively simple question to answer. But it's at this point that I wanted to pose a very simple question, but this very simple question has quite a complex answer to it. And that is, you know, if we're playing a game of spot the difference, and you've all seen those ones where you have two images on a screen and you have to circle everything that's different about those two images, then, you know, what is the difference between these two images that I've just put up there? Now, without making this into a poll question or doing anything else, the obvious thing is the wording that I have used. I have indicated one is an employee share scheme and the other is an employee share offer. Now, that wording itself may be meaningless to a lot of people, but to the capacity for a fund to acquire certain shares, it can mean everything, because employee share schemes are actually defined by tax law, and so it's ultimately an employee entitlement that the company is providing to all or a subset of employees within a company as some form of remuneration / reward for service. But it's part of their packaging, and there's significant taxation considerations to think through with regards to employee share schemes. And often we get asked a question whether a self-managed super fund can acquire shares that have been provided for under an employee share scheme. Now, the short answer in most situations is no, right? Because in most of those situations, we're talking about unlisted companies. In most of those situations, we're talking about unrelated companies, right? And so we're actually not satisfying the definition of a listed security, and we're not satisfying the definition of an in-house asset. So largely employee share schemes, where what you're effectively doing is you're taking the right that has been provided to that employee and you are then saying, well, that employee is transferring that right to the self-managed super fund. So the super fund is ultimately acquiring that right from the employee, and ultimately it's going to be a breach of that section. And SMSF ruling 2010-1 talks about what actually the asset is, whether it's right or what the substantive asset is, whether a contract gives you the right to acquire something, but then is it actually that contract? Is it that right or the final asset? And that's where I want to differentiate and sort of pivot to employee share offers. So last year we went through, or the year before it actually started, went through a process where a number of our funds acquired certain shares under an employee share offer. Now we had some good discussions with our fund auditors on this matter, and for me it was a matter of not of reputation as such, but when I first read the request, can we acquire shares under this employee share offer, I was fairly adamant straight away that the answer to that was yes, because it was shares that you had to apply for, and you had to apply from the actual company itself, and then the company had the right to accept or deny your application. So the auditors, quite rightly, I felt in this situation, did question the transaction to say, okay, well, look, would the super fund have had the capacity or the ability to acquire those shares if it wasn't for the employee working there, and therefore giving the super fund access to the transaction? I said, well, that ultimately for me was only one element of the transaction. It doesn't actually change the nature of the acquisition rules, and the acquisition rules really only looks at who are you acquiring the asset from. And so under an employee share scheme, that's actually employee entitlement. So you're acquiring those shares from the employee. The employee share offer, right, where it's open to potentially all of the employees, and then subject to the discretion of the actual offer itself as to whether or not you get accepted and how much you get accepted. There's no guarantee, there are no rights imposed on the employee there. And so we actually went through the process here of applying for SMSF specific advice from the ATO under the question of whether or not an acquisition under an employee share offer was acceptable under, or whether it was a breach of Section 66 or not. And look, thankfully the ATO came back and said, well, because because there is no effective arrangement in place where the employees just get that entitlement regardless of whether they apply or not, and because the application is subject to an acceptance or a decline nature from the board, and because it's non-related, it's not actually an acquisition from a related party, so therefore the transaction is acceptable. And so it's one of those scenarios that I would always say to people is always be mindful of what you're actually acquiring, because most of these employee share offers will actually use words like employee share scheme. And then quite rightly, the auditor is going to come down and say, well, you can't undertake an acquisition under an employee share scheme. And so you need to be careful that you've got access to all of the materials, and then that the ATO are in that position of being able to make the assessment on your behalf. It's also important to be able to ask the right questions of the tax office as well. But if you go through the process of asking who the acquisition is from, right, then in this instance, because of the application process, because you're actually sending an application across to a third party that's unrelated, then it wasn't going to be a breach of that section. So I felt that was an important one to raise. So then when we talk about the investments, and I said I'd raise these points again. So listed securities and business real property really aren't too critical. Or when I say they're not too critical, they're exceptionally critical to the decision-making process, but they're more of a known entity with reference to what we can and cannot acquire from a related party, and so we won't spend a great deal of time on it. What I want to focus on is more about the in-house assets, and then the certain assets that are excluded from the in-house asset rules to determine whether or not they can be acquired. So as I said, business real property in itself is its own subject matter as to whether something meets the definition, but that's going to be the key to the transaction. Is you need to determine whether or not it meets the definition of business real property. Once you've done that, then the acquisition is going to be fine as long as it's at market value. So with in-house assets, we need to know that an in-house asset is a loan to or an investment in a related party of the fund, an investment in a related trust of the fund, or an asset of the fund subject to a lease or lease arrangement between the trustee of the fund and a related party of the fund. So that's a fairly broad definition. And as I said, that last part of it there, the asset subject to a lease, has been carved out of the acquisition rules. So we aren't able to acquire an asset subject to those lease requirements. So we're ultimately looking to loans to and investments in related parties and investments in related trusts. So when we do look at these investments, we're looking at private company shares of a related company, loans to related company or trust, and interest in related unit trusts. And all of those investments are restricted to 5%. And I'm going to talk about 1322C in a moment, but all those investments are limited to 5% investment. So when we touch on the whole idea of investing in a private company or an unlisted company, if it's related, right, it will be an in-house asset. That means if it's related and is an in-house asset, means we can acquire those shares from ourselves, but we're restricted to a 5% investment. Loans to a related company, loans to a related trust. This is one of the awkward elements of the in-house asset definition, is that we have a Section 65 prohibition on lending and providing financial assistance to members or relatives, but then we have an in-house asset definition that provides the capacity to loan to companies or trusts. But all of these definitions and that also have effectively the anti-avoidance requirements, and we can't enter into, and if you look at the financial assistance ruling that I referenced before, 2008-1, if you look at Section 65, it basically says Section 65 overrides the in-house asset rules. And so ultimately, if we're setting up loans to related companies and related trusts, those loans have to be commercial loans for the purposes of those company or trusts, not for those company or trusts to then on-lend to a related party being a member or relative. So, you know, there's always going to be questions asked about the legitimacy of loans to related companies or trusts from an SMSF point of view. But once they're in place, you can certainly acquire them. And I saw one happen only last few months where a related party loan was actually acquired from one party within the self-managed super funds. These transactions must be at market value. If it's an in-house asset when acquired, then it must not breach the 5% test. So this is where that valuation question or that valuation comment comes in. So if it is an in-house asset, so those 3 points above, then the investment at that acquisition point must be less than 5%. You've also got your annual test that you're doing for in-house assets, but from an acquisition point, you can't be breaching the 5%. Now that means if you've already got 3% of investments in in-house assets, it doesn't mean that you can then invest in something that's worth 5%. You've only got up to that additional 2% to be able to bring it in. So you need to be mindful of the entirety of the fund's in-house assets. And I've highlighted that point about lessable assets before. And then you've got the other assets that when acquired are listed exceptions to the in-house asset rules, where you've got your deposits with a bank, which is fine, widely held trusts. So these are your trusts with no fewer than 20 shareholders with distributions and income and capital up to that 75%. So fairly complex definition to look at when we're dealing with widely held trusts. But know that most managed funds that are trusts set up and satisfy the widely held requirements because there is a large cohort of investors in those trusts. Business real property leased to a related party. So this is effectively the carve out to the other leasing requirements, where if you've got other assets subject to a lease to a related party, you can't acquire them. But if the asset subject to a lease to a related party is business real property, then the business real property exception sort of takes over and takes precedence there. So business real property being the golden egg of SMSF transfer investments. Regulation 1322C trusts and companies, I said 22C because we're talking about investments since the year 2000. LRBA holding trust. So this is an interesting one because there's two sort of potential acquisition points, and legislative instrument was written to cover off on both. And one is that you set up a trust that's effectively a related trust, but doesn't hold the in-house asset yet. So that's pre the LRBA occurring, and then you hold that trust and you either transfer it to the SMSF trustee or you don't afterwards. And there's an exception to the in-house asset rules there. But what it also provides for ultimately is that you can transfer the property under an LRBA from the holding trustee to an SMSF trustee without breaching the acquisition of assets from a related party rule. So you've got that further extensions. And then certain life policies, but not if those policies are held personally. The rules around our non-geared investments, our 1322B and C investments, and I guess this is where it's pretty critical, and it comes back a little bit to Sunil's question earlier. But we're looking at funds. Whoops, I haven't updated that 5 members bit there. Sorry, for fewer than 7 or no more than 6 members that does not borrow. So the trust doesn't borrow. The trust does not invest or loan money to individuals or other entities, right, other than holding a bank account. Does not hold interest in other unit trusts or companies. Has not acquired assets from a related party of the super fund other than business real property. Does not lease assets to related parties other than lease a business real property to a related party on arm's length terms. Does not carry on a business and conducts all other transactions on an arm's length basis. So that's a summary of the 1322C requirements, which is why I say before that it doesn't have to be related to be able to transfer it in. It just has to be non-geared to be able to provide for that exception. But I wanted just to dig a little bit deeper into that before. So when you've got these investments, they do satisfy the exception to the in-house asset rule and provide quite a bonus from an investment point of view. If a fund can't afford to, say, acquire business real property outright, but that property is in a trust, then you can buy the units, over a period of time. So it can be a way, or if you don't want lending inside the super fund, that a related party can lend against other assets and buy units, and then you can acquire the units over time via the use of the 1322C investment vehicles. So it's one of those areas that it provides great capacity, but it also potentially comes with great issues, because if you undertake any of the activities to the negative of what I've just summarised, then so that trust does borrow, that trust doesn't conduct on an arm's length basis, it leases assets other than business real property to a related party, or it acquires shares in another company or units in another trust, then you're in breach of 1322D, or you've undertaken a 1322D event, and then that asset will be an in-house asset. And so you are then back to the 5% restriction, whereas the 1322C requirements don't have that 5% limitation. One of the other traps of in-house assets that I always want to address in these acquisitions, because this is almost acquisition by stealth, and that is that when we talk through the concept of what is an in-house asset, and we look at the concept of 1322C, we look at the concept of, say, a pre-99 unit trust, or we potentially look at an investment in a related trust where we are restricted to 5% because it doesn't meet the conditions of 1322C. Is that, and the ATO released something last week in draft format, which was largely around Div 7A and other parts of companies and trusts working together and having unpaid present entitlements. Well, self-managed super funds are often presented with unpaid present entitlements when the related trust dictates or determines what the distribution is, and then from a timing point of view, that distribution often takes a little bit of time to go into the self-managed super fund. So the reality is that time frame should be is that the income is declared at the end of the financial year. It's often not worked out until some part into the next year, but then once it's worked out, it should actually be accommodated for at that point in time. To then have the unpaid trust distribution, and the ATO have a separate ruling on this as well, which I think is 209/3, that unpaid trust distribution could be deemed as a loan because you're providing financial accommodation to the trust, and therefore it's a loan, it would be an in-house asset. So whether or not you just reinvested distribution, that could trigger an in-house asset, but if it's a loan, it would definitely be an in-house asset. And so you need to be mindful of that. So if you're working in 1322C, then a redistribution would be acceptable because you're meeting all the other conditions. But if it triggers over and becomes a loan, then you've got issues to contemplate. So I find that there's all these traps that we need to be mindful of once we start dealing particularly with unit trusts inside the super fund, because if we've got anything unpaid, then how is that going to trigger other events occurring from an acquisition point of view? So acquisition isn't always a known entity, because you might inadvertently acquire something by not acting in the sense of distributions from the trust. And the other one, the catch-22 that I wanted to talk about, is that we get the question asked, can I buy shares in this company so I own shares in a private company, and I want to transfer those shares into the self-managed super fund. So that, as I said, is often the trigger for people to try and enter into schemes by saying, well, if I buy yours and you buy mine, and we do this triangular sort of event, then that's going to be potentially problematic because you're entering into a scheme to avoid the in-house asset rules. But the catch-22 for me is that the answer to that question, can I acquire shares in that company? Well, then we have to say, well, who are we buying those shares from? So, well, I'm buying those shares from myself. So, okay, well, then you are a related party. What is the investment? Well, the investment is shares in this company, right? So then we have to say, is that company listed? No, it's not. Is that company business real property? No, it's not, right? So is that company an investment in a related company? So then we need to know whether or not it's a related company. So then we have to link back to the majority voting interest and sufficient influence definitions to determine whether or not that investment is going to satisfy the requirements to meet the exception under the acquisition rules. But the catch to all that is, and this is where I guess the caveat of sole purpose testing and all those other things come into it, is if you satisfy all that condition, and if you can juggle, for want of a better term, the definition of sufficient influence to say that you influence that company, then once those shares are in the super fund, you're restricted to only having 5% of the value of your funds invested in that company. So if you start out at that 5% level, and then that company has some good success and remains a related company, well, then you're going to be in breach of the ongoing in-house asset rules, and you're going to have to continually sell down those investments. So it's catch-22 in that, in trying to achieve an outcome from an acquisition point of view, could put you in an ongoing in-house asset scenario if you're sitting borderline with that 5% investment. So often those related party transactions, and of course, linking back to the whole provision of financial assistance, are you acquiring those shares to put some capital into the company? Are you buying those shares to put some capital back into yourself? What is the true purpose behind that transaction? And so similarly with that scenario that I took to the SMSF advice piece from the ATO, the question really shouldn't have been, or the question wasn't, should you or can you acquire these investments? It's more about, should you acquire the investment? And so long as you've contemplated that investment in accordance with the fund's investment strategy, looked at it from a long-term income or capital point of view for the provision of retirement benefits, then you're crossing the boxes on those sorts of scenarios versus the cash flow situation. And of course, if you're buying it from an unrelated party, then the cash flow is not so much going to yourself. And so that's a good sort of segue into the final part of this, which is to talk about that ATO support and penalties element. Because if we touch on the SMSF advice process that I went through, it took a little bit of time to get there, but to get these things wrong. So let's say that in that instance that the auditors have reported an ACR, so this is a contravention of the acquisition of assets from related party rules. Section 66 is not one of the provisions that are subject to SMSF administration penalties. They are subject to a penalty of up to 1 year imprisonment. So that in itself, should be a deterrent. How many of the 1% of self-managed super fund contraventions that were reported, let's assume that half of those weren't rectified, how many of those have ended up in prison? I think we can probably largely safely assume 0 is the answer to that. But then what process have they undertaken to go through steps to rectify that situation with the ATO? And that's obviously going to be the key, is if you acquire assets, ignore the advice, and therefore ignore the contravention and the rectification, then you've got this 1 year imprisonment. Of course, all those other investment restrictions that I've touched on, sole purpose test, the lending provisions, separation of assets, they will fall under sections that are capable of being penalised under the SMSF penalty regime. And so ultimately the concept of acquiring assets could lead to other penalties inside the fund to be mindful of. So it's better to get it right. And how do we get it right? Well, there's really two ways to get it right. There's the upfront way to get it right, and that is to know that it's right in the first instance. But secondly, pre-planning is the best planning. So you can use the SMSF, or you can go in and use the request for self-managed fund specific advice, right? Where you have to lodge this with the ATO. Generally, they want this to occur in the year of the transaction, but they'll also allow you to provide for this right up until effectively any contravention has been reported. So, whilst you're still working out, even if you're in discussions with the fund auditor, as was the case in the one that I dealt with, we actually applied for SMSF specific advice before we finalised the fund audit as such. What can the ATO provide advice on? Well, specifically, it's around the investment rules to do with the funds. So you've got in-house asset rules, acquisition of assets from a related party, business real property definition. They will or they can provide guidance on those definitions. So what can be handy here is you may ask the question, is the following investment an in-house asset? Then if you get that question, is it an in-house asset? You probably answered the second question of, can I acquire this asset from a related party? So you can ask it as a single question, which will then give you the answer to the second question, or you can pose it as, can I acquire an asset under section 66, 2A being the in-house asset one? Here is the definition, and then provide all the definition of the asset, and doesn't meet the definition of an in-house asset form. So you can go about it one of two ways. I went about it by asking the question, can we acquire an asset from a related party? That's the link to using that form. The second method is the SMSF voluntary disclosure. So this is when you've done the wrong thing, and it's been proven that you've done the wrong thing because everybody agrees that you've done the wrong thing. What you do here is you get on the front foot. Right? And by getting on the front foot, you lodge a voluntary disclosure. So you have this SMSF regulatory contravention disclosure. You go to the ATO before the contravention is reported by the auditor. The auditor will still report, but at least you've gone to the ATO and you have an unrectified breach, and you have a plan in place to deal with that breach. The ATO encourage you to do and lodge under a voluntary disclosure, and they will take that into consideration in contemplation of any sort of enforcement activity or penalties and subsequently penalty remission. The voluntary disclosure, I don't think can necessarily be, well, we're not going to do anything, because then you're not really disclosing too much. But it may be that under that voluntary disclosure, you have a means of saying that, such as, and not so much under the acquisition rules, but the in-house asset rules. So if you've got an investment property or whatever it might be, and a related party moves in, and we know that that's an in-house asset, well, if you disclose that to the ATO and you disclose the steps that are being taken to ensure that doesn't happen again, then maybe the ATO look happily upon that and say, okay, as long as it doesn't happen again, then you can keep that asset. But of course, if you then do it again, you can expect the full extent of the law to come down on you. So the voluntary disclosure is a great way of engaging with the ATO to deal with these certain matters. So for me, it's important to understand that the rules really do require us to ask one question to start with, and then follow that by a second and subsequent question if we're dealing with in-house assets. Always know who you're dealing with, right? So that's the first question that we've got to ask. Then once we know who we're dealing with, if it's not related, you don't have to ask any more questions. You've just got to deal on a market point of view, market valuation point of view, for your gnarly rules and likewise. But once we know who we're dealing with, if they're related, can I deal with them? Can I actually make this acquisition? And that's when you might need to get into the crux of what the investment is. Is it listed? No, because generally no one asks that question about listed securities. Is it business real property? Yes, no. Is it an in-house asset? Yes, no. If it's not an in-house asset, is an exception to the in-house asset rules. And if it is an in-house asset, then do we meet that 5% requirement? So they're the rules and the ways we need to go about it. And so, yeah, I agree. And comments just come through from Damien. Best to have a plan in place to rectify before the audit is finalised, so the auditor can include this in the contravention. Absolutely, that is spot on there, Damien. That's really what we want to see, is that you've always got that plan in place, because one of the key stats from the ATO is I think 45% of all breaches aren't rectified when they get to the ATO. So look, thanks for joining me. I've got a lot of information with regards to this related party transaction stuff, and my goal is to be able to send you a link to some of that, and particularly the extended definition of some of these things and the rules around 1322C, because I didn't want to bombard you with too much text today. So I'll put a link to some of those guides in the CPD stuff. As I said, I will confirm the question as asked or posed from Sunil. So thank you for that question again. My next webinar continues the theme around investment restrictions inside funds, and I'm going to look at borrowing in a self-managed super fund, so dealing with LRBAs and also other rules, and that's going to be on the 6th of April. So look, thank you very much for joining me today. Always enjoy bringing these sessions to you. Hopefully it gives you a bit of insight to some of the issues that people can address when dealing with their clients in this space. So thanks a lot, and I look forward to seeing you all in April.